Hello everyone, welcome to today's market mood for Saturday, June the 29th. Today's is going to be a little bit different. We're going to take this market mood and we're going to also put it over on YouTube. So for those of you that are here and watching us on YouTube, thank you for being here. And if this is the first time that you're with us, make sure that you like and subscribe so that way it not only helps this get out to more people, but it also helps to make sure that you receive upcoming episodes of all things that we're going to be doing over here on YouTube. So without further ado, let's hop into what we have for today. So first off, let me make my face a little bit small there. There we go. And overview. So stocks and markets are continuing to rotate. We've seen that all month long. And you know what? It's okay. And it's okay because, well, we ignored the old colloquialism of sell in May and go away. Dennis and I discussed this last month over on the Trading Truths podcast. And you know what? Just like they say a blind squirrel finds a nut, or a broken clock is right twice a day, so is the sell in May and go away. But it wasn't right this time because, well, for me, June ended up being the best performance month that I've had this year by far. And so I tell that not to, hopefully it doesn't come off as being boastful or anything like that, because trust me, I've had my fair share of months that did not go so well. But the main point is that, sure, sometimes these things that we hear like sell in May and go away, sometimes they end up being right, but oftentimes, that's just a coincidence. And what we need to pay attention to is the things that we're about to jump into on the next slide. So what's this? If you've been on this channel before, you know exactly what this is. This is how I go about defining market mood. The most robust way for us to look at the market's mood is to look at it through this three-dimensional lens of where we're taking an assessment of the general market condition, where we're diving into our systems, and then we're taking a look at our own personal performance. If you were to think about this like going food shopping, it would be go to the grocery store, right? That's the general market. Then you take a look at the stuff inside the store. That will be your system. And then what you end up bringing home, well, that's your personal performance. So if you were to go to the grocery store and it's nice and it's fully stocked, well, that's a good general market and also a pretty good system, right? Because the shelves are stocked and the things that you want to find at the grocery store, they're there, right? And they at least look like they're in pretty good shape. Great. So you go, you take it home, and everything is nice and fresh, and you don't find the moldy strawberries at the bottom of the container. Everything is nice and fresh, and it stays for a while. All of that would lead to what would be here a green condition. But let's say that's not really the case. Let's say that, it's a stormy day. Maybe the streets are a little bit flooded. You have trouble getting to the grocery store. And when you get to the grocery store, well, there's not a whole lot there because the trucks that would bring the food to the grocery store, well, they had trouble getting there because of the floods in the streets. So what you find in the store isn't exactly what you're looking for, and the shelves aren't really fully stocked. And then you take what's there, you bring it home, and you do find that, the stuff that I brought home kind of turned to mush within a few days. Well, that would lead us to the red condition, and the yellow condition is everything in between. So that said, let's take this analogy and dive into markets. So starting off, and we'll look at charts too. The general market, here are the main points that I observed. So in the general market, the indexes continued to consolidate on both the daily and the weekly time frames. The monthly charts are basically par for the course. The daily charts are starting to show outside negative reversals. That's on both the NASDAQ and on the S&P 500. So let's go take a look at those charts and see. So here are the daily time frames. And I'll turn off my annotations because I like to draw all over the charts, and sometimes it makes it be a little bit noisy. But we have the S&P 500 over here, the NASDAQ, the Russell 2000, the New York Stock Exchange, the Dow, and over here is the IBD 50. And for those of you that don't know what the IBD 50 is, IBD stands for Investors Business Daily. It's not the other thing that IBD stands for. And basically, it helps to track growth stocks. And those are the kinds of stocks that I'm interested in. Those are the kinds of stocks that can typically make 50 to 100% in about 6 to 12 months. And so because those ones can compound a lot quicker, I want to try to find those ones and focus on that pile. So on the indexes, we've been moving steadily up on both the S&P 500 and on the NASDAQ. We've been chopping around on the Russell, the NYSE, and the Dow. And last week, on Friday, two significant things happened. On Friday, the Russell 2000 moved above its 50-day moving average and followed through above its 50-day moving average, and it hasn't done that in quite a while. We've had a little pop above the 50-day moving average over here a couple of weeks ago, and it attempted to get above it back here last week, and now it's finally starting to move back above its own 50-day moving average. Whether or not this will lead to something, well, that remains to be seen, right? It's always one day at a time. We don't want to get too far ahead of ourselves, but we could still take a look at the whole picture and see, well, which way do we want to position ourselves to be open to the opportunities that are being given. Up here with the S&P 500 and the NASDAQ, what happened on Friday was a negative outside reversal day. So price initially pushed higher. Price initially pushed into fresh all-time highs on the S&P 500. But what happened at the end of the day, prices were sold off. They closed at the bottom of their trading range, and it completely encapsulated all the action from the day immediately before it. That's a negative outside reversal day in a nutshell. Also, it counted as a distribution day, a day where there's more institutional selling in the market. And we know that because the prices weren't just down, they were down more than 0.2%, and volume was heavier than the day immediately before it. This is something that William O'Neill discovered in his historical analysis going all the way back to the 1800s. And when you get distribution days, if you start to get a big pile of them all together, it's one of the things that can push the market over. So that's why I actively look for and track the number of distribution days in the market. And when they show up and how they show up can matter as well. If we take a look at what happened here with the distribution showing up just as the market is getting to fresh all-time highs, and it also putting in a negative outside reversal bar, that's one of the things that can mark a short-term top. Now, am I saying that the S&P topped out? Well, maybe the S&P briefly is getting ready to pause, but again, we're not in a topping out market per se. We are in a rotational market, because if we were in a market that's getting ready to take a big nosedive, the signals that we would get would be more in alignment. It would be less of where we have the S&P 500 having this negative outside reversal day, and not only that, the NASDAQ had it as well. You would start to see the other indexes getting ready to falter too. and getting ready to break down. That's not the case. So if we're starting to see the Russell starting to turn around and the Dow and the NYSE moving sideways, that's showing more rotation. And as we get deeper into this presentation, you'll see even more evidence of rotation. So let's talk about a few other things that we had on the slide deck. So let's see, where were we? Oh, monthly charts, par for the course. So we'll take a look at the monthly charts, and I also want to show you a spreadsheet that I keep every week. So here are the monthly charts, and if you're taking a look at the market on a monthly basis, you'd be like, well, what are you getting all concerned about from this daily time frame, right? The S&P 500 closed near its monthly highs. So did the NASDAQ. It's almost like what happened on the daily, all non-events. And same thing over here on the Russell, on the NYSE, and on the Dow. Just consolidating sideways, no big deal. If you were, say, a cruise ship out on the ocean, and picture yourself driving this big, massive cruise ship, and there's some tiny little waves that are coming by, maybe for a speedboat or a rowboat or something like that, you're bouncing all over the place. But for a cruise ship, you're not even feeling that. That's what's happening with this right here. So that is another element of the rotational kind of market. And depending upon the type of style that you're trading, if you are a position trader, typically position traders like to sit and hold for a much larger move and are in positions for several months. You're looking more at this, and the choppiness on the daily, not too big of a deal. But if you are a shorter term swing trader, or if you are let's say that you're a day trader, right, the shorter time frames, then you're really feeling what's happening here. It doesn't mean in a good way or a bad way. You could trade this very well. Let's continue. Let's continue. All right, so here's another key point. New highs start to eke past new lows. Now, let me show you the spreadsheet that we were talking about before. Let's get the market mood log up. And so let's also increase the size of the font so that way you can see it a bit better. So we've got a whole bunch of things on this spreadsheet. I keep this spreadsheet going every single day. It looks like a lot, but this really takes me just a few minutes each day to update. I track the trends of the indexes on each time frame. So I've got the monthly, weekly, and daily time frames over here. You might notice the colors changing a little bit, right? So over here, there's a yellowish, or almost like a mustardy yellow. And then there's black, and then there's green over here. When the font is black, that means that it's been stable day to day or week to week. If it's a different color, then that means that it changed. So the more colorful this becomes, that's showing more change. And if there's constant change, then that's something that visually tells me right away that, you know what, there's some of that rotation going on, perhaps some choppiness, something to be aware of. And so that's how I color code this for myself. Anyhow, we are coming over here to look at the number of stocks that made new 52-week highs versus new 52-week lows. And this is something that we've been talking about for a little while, because as the S&P 500, as the NASDAQ have pushed into new high ground, you can see that there's been more new lows being made, more new 52-week lows than 52-week highs for the most part. That is not what you would expect to see in a robust trend. It's something else that's representative of a rotational market. If the market, if the NASDAQ, S&P, any of the other indexes are continuously pushing higher, but most of the stocks within them are not participating, then that's something that's showing this rotation higher. You're able to make money in these environments. Again, I mentioned that June was personally the best month that I've had for the 2024 so far, and we'll take a look at some of those trades for June, but it makes for an environment that isn't quite as easy to trade, right? Like, so if you were to picture a bag, right? A bag full of marbles. And for those of you that are familiar with Van Tharp, you know his marble bag analogy. So picture you close your eyes and you reach your hand into a bag and you pull out a marble, and there's all different colored marbles in there. And let's say that you pull out a blue marble, and the blue marble represents a win. Great. So what the new highs and new lows are telling us is that right now there's a lot more red marbles in the bag, right? So let's say that red marbles represent losses. There's a lot more red marbles in the bag than blue marbles. So if you were to reach your hand in and pull out a marble at random, it's more likely to be red, and therefore it's less easy to just randomly hit on a winning trade. And so that's one of the reasons why it's important to have a robust trading process, especially if you are someone that is looking to trade individual stocks. Let's continue. Well, where's the... here's the slide deck. All right, distribution. Distribution is still low. So back over to the spreadsheet. The spreadsheet here shows that distribution, there's only been 5 distribution days over the last 25 days. There's only been 2 distribution days in the last 10. The reason why that part is important, again, is because if we start to get too many distribution days in a row, then that's something that can tip the boat over and cause a much deeper pullback. Right now, there's only 2 on the S&P 500. There are 0 in the last 10 days on the Dow, so not a whole lot of distribution presently. So if we come back over to the slide deck, go over to the next slide. Presently, if we're looking at our traffic signal, the general market is red. And the reason why it's red, instead of say yellow, you might say, oh, you know what, well, we actually saw some positive things. And yeah, you could make a case for it being yellow. The reason why I'm taking the more conservative approach in saying red is because of that negative outside reversal bar that we saw over on the S&P 500 and on the NASDAQ. It's not a time when, if we were sitting in our car and we're about to step on the gas a little bit, it's still one of those occasions where we're sitting in traffic and maybe we're starting to see traffic open up a little bit. It's not time to start to really press on the gas. We're getting a little bit of momentum, but it's still time to be cautious here. So that's why, for me, I'm looking at it as a red environment. And it doesn't mean don't trade. It just means, hey, be extra cautious. That's how I look at it. Let's take a look at the next slide over here. So now we're talking about the system. So current stocks, breadth, and quality. The way that I go about taking a look at the system, I look at it as a funnel. Right? So there's about 10,000 or so stocks in the market. I'm screening using a tool called Market Surge. I'm actually in the process of testing out another screening tool called Deepview. Those guys reached out to me and gave me access to it, so shout out to the guys over at Deepview. Thank you very much for that. I'm testing it so far. I'm liking it very well, but I'm still doing the screening in Market Surge for right now. Anyhow, so I'm taking the market, 10,000 or so stocks, and I want to whittle it down into the ones that have the greatest chance of having that 50 to 100% move in 6 to 12 months. Which ones are the ones that are those? The ones that have very strong earnings and sales and the things that William O'Neill talks about in his book, How to Make Money in Stocks. I talk about it in my book, The Trading Mind Wheel. Mark Minervini talks about it in his books. We're all basically looking for growth stocks that can move fairly quickly. And historically, those stocks have been the ones with extraordinary earnings, extraordinary sales, that have been in leading industry groups or rapidly improving industry groups, have had the market at its back. And they also set up, and we'll talk about those kinds of setups too. But for right now, there are 345 names that I found that fit this criteria. A little bit less than the week before. Okay, that's all right. It's not a dramatic change. 4 names is not that big of a change. What is a larger change is the breadth. So the stocks that are setting up. So what is a setup? A setup is the way that I look at a setup is that it's a consolidation of a historically based pattern. So some of the things that O'Neill found: cups with handles, double bottoms, flat bases, high type flags, those kinds of things. It's important to clearly define what our setups are going to be. And it's a little bit more than reading about it in a book. So if you've read O'Neill, if you've read my work, there's samples in there, and there's models to follow. But the more important thing is to, yes, read the books, become familiar. That's going to be your shortcut to success. But what you also want to do is go out and find these things yourself and build your own models, because that's going to ingrain it in your mind and train your eyes to spot these things, and you'll be able to spot them like that. And then those will be your setups, and you won't be looking for anything else, right? So go back to the grocery store analogy. Take the person that is going to the grocery store, has their list, knows exactly what they're going to find, what they want to buy, and how do they act when they get to the grocery store? They're in and out, right? Within a couple of minutes. Versus the person that doesn't really know, and so maybe they're walking around every single aisle, going up and down and up and down. Oh, here's something that's interesting. They pull it off the shelf. They'll read the label. Oh, here's a free sample. Let's go that. And the trip to the grocery store takes a couple hours, right? So the more that we know our setups, the more we're going to be very efficient in and out of the market. And that's actually the process, right? I've spoken about this before, but to rehash here. And that's the process that allowed me to trade all this way. Back when I had my day job, I learned about O'Neill and Can Slim and all this stuff back in 2010. I started to apply it, and I consistently applied it. And by 2018, I was able to leave the day job behind, and now I'm doing this full time. Like trading, but also being here and teaching. And my personal process hasn't changed much, but the reason why I was able to teach and also trade while I was still at a day job was because the process became so efficient. I was able to go to the grocery store, find exactly what I wanted, find it, and get out, right? Not just going up and down the grocery store aisle. So that's what this is. Anyhow, so long story short, there's less stocks setting up this week than last week. Last week there were 50. This week there's only 28. This week the quality is less to kick things off. B and C level setups versus what I would consider an A-level setup, and an A-level setup would be something that closely fits the model book setup that we were talking about earlier. So to start off the week, I'm not placing any new working orders, and there's nothing that I even want to set an alert on just yet. But we'll still take a look at stocks and take a deeper look there. As far as the stocks overall that are setting up, this is something that's important to consider as well. What groups and what sectors have the most setup? So presently, far and away, software, right? It's sticking out like a sore thumb. Then, distant second is finance, and in third place, retail, and then you have a few other sectors that are sitting up there. Mostly software, and this actually raises a very good point too, because over the past couple of weeks, I've heard that all of tech is kind of out of favor, and it's these other things. Well, isn't software part of tech? Well, what broke out last week? Cybersecurity was one of the biggest sectors to break out last week, and I'm trading CyberArk. We had Palo Alto. There were a few other names, but yeah, we need to pay attention to what the market is actually doing versus someone else's interpretation. And the way to do that, well, if you follow this process and putting the process out there, you can take the process and go and do it yourself. If you want to follow along with what I'm doing, we have a research program. I'll put a link somewhere so that way you could take a free 2-week trial and see what it's all about. But this is how you can let the market speak to you versus needing to rely on someone else's opinion. Anyhow, let's continue here. All right, so last week's system performance. So the setups, how did they do? 54% of setups finished positive on the week. Okay, that doesn't seem too bad. But 34% are consolidating, meaning that you still had the vast majority of them in that chop zone. So some were consolidating positively, some were consolidating negatively, and that's one of the things in this rotational kind of market that makes it challenging. And so that's also one of the reasons why we need to know about position sizing, how much to bet, because we could go in heavy and get chopped up. Anyhow, let's take a look at a few of the stocks that were consolidating last week. So let's come over to, got all these different lists here. Let's go to the ones that broke out first. So here are a few of the ones that broke out and did very nicely. We'll take a look at the weekly charts here. So each one of these were on my focus list, the stocks that were setting up that were actionable during the week. And so these are the ones that did well, that moved on up, right? So we've got that, FICO, Interactive Brokers off the 10-week line, right? Like, so you could even see that some of them moved out pretty well. Some of them had little breakouts. Palo Alto did fairly well. Varonis Systems moved up about 8% from the pivot area. Uber, fairly choppy. Uber's entry point was down here. I adjusted it because it's one of the things that we'll take a look at later on for setups. And then Parsons Corporation off the 50-day moving average, moving up on heavier volume there. Okay, so we've got a few, but there were also plenty that broke right down. Here's one that would have triggered an entry point, reverse, closed on its lows. Here's another one, right? You wouldn't consider any of this to be very good action. And I find it very helpful to track all of the setups, not just the ones that do well, but also the ones that don't do well, some of the ones that do mediocre, and we'll take a look at those, because that's going to tell us how good is the environment, right? Remember that marble analogy? Well, this is telling us what's in the bag. So we go through this and you can see that, yeah, you know what? There were quite a few stinkers in there. And if we take a look at the ones that were consolidating, well, some of them were stinkers. Some of them didn't really move that well. Some of them are just above the entry point. But this is 2/3 of the list that is still hanging out near what you might consider the buy points. And it's something that points towards a rotational kind of market. So when we take a look at last week's performance and some observations from last week's performance, there was plenty of chop, like you just saw. 1/6 of stocks broke out, right? Just 1/6. And that means that you had a 5 out of 6 chance of either getting chopped up or taking losses. Not that great. And that's one of the reasons why it's time for caution, right? Like if everything were breaking out and doing fantastic, well, then that would be time for the traffic is lightening up and let's start putting some more dollars to work. But that wasn't the case here. As far as which groups were working here, not software, but software and finance only. They're really the only shows in town. Right? So there's software. Finance was somewhere over here. I don't know why it's not. Oh yeah, there's finance. Right? You can barely see finance. It's really mostly software. Here are the names that broke out. So what were some of the names? VRNS, SFM, CYBR, PSN, MATX, ACIW. Those are some of the bigger winners from last week. So as far as your system goes, I would still look at that as red. Sure, there were a few big winners, but could you put a blindfold on and reach into the bag and pull out a winner? That wouldn't be so easy. You needed to be fairly selective last week. And so because it was a more challenging environment, it's not the time to be betting heavy, in my opinion. And so that's why I look at that as time for caution, red condition. Now let's take a look at personal performance. So here's how things went for me last week. So I have 3 open trades presently. I'm still holding CyberArk, CYBR. I started a position in Texas Roadhouse, and I started a position in MFC. Let's take a look at each one of those. So open trades. Okay. So I started this position in CyberArk a couple of weeks ago, back here. I think June the 17th was when it broke out. So I'm in this, and it's inching along, and then finally this week it started to have some decent moves. And so I took my first scale out on Friday. I like to scale out into strength on trades, lock in gains as they move, and it's not at arbitrary spots. It has a lot to do with recent performance, how the winners have done, how stocks are doing, and because at least the stocks that are doing well have run further, and we'll take a look at that too. Because of that, I wanted to give this one a little bit more room to run. And so it ran a little bit more than 1 times my risk. I risked initially 6% on this. I took my first scale out at roughly 7, maybe 7.5%. Let's see. Yeah, about 7.5%. So that's one of the big recipes for success, right? Well, we want to risk this much, we want to gain this much, and if you do that over and over and over again, well, if you're just flipping a quarter, right? Heads you win, tails you lose. Well, if you get paid $2 on your winner and you lose $1 on your loser, well, keep on flipping that coin all day long, and that's basically the system that I've created for myself here, where I'm risking a small amount, hopes to make a larger amount. So started to lock in some of the gain there. My stop is at break even, so it's only the profit that's at risk on this one. Here's Texas Roadhouse. Texas Roadhouse actually came close to triggering a sell for me, an early sell. So it broke out of what I saw as a flat base, and it triggered the entry point, then reversed and closed near its lows on the day. My stop loss on this one is 168.90, and on the day you can see that it had 5 danger signals. That's not good, especially when a trade is brand new. For me, my threshold is 6 danger signals. 6 danger signals at this point in the trade, automatic sell. And that's not arbitrary either. That's me going back through all my past trades and finding, you know what? Well, when I get 6 danger signals this early, it's very, very unlikely that this is going to be one of the big winners. But because it had 5, I chose to hold on. And also, when I take a look at the 30-minute time frame, I take a look at, well, what did price do at the end? It was so close to getting cut. It was like at 6 danger signals right down here. Then it rallied into the close off of the 21 EMA, off of the anchored VWAP, and closed at least at the high on that 30-minute bar on heavy volume. So it earned the benefit of doubt at this point. So I'm still holding Texas Roadhouse, even though I'm not happy. I shouldn't say not happy, but not thrilled with that kind of a squatting action. Over to MFC, Manulife Financial Corporation. So this one broke out. It squatted as well, but it still closed up on the day. It still closed up on the week. If we're taking a look at the weekly chart, this is still a fairly strong move on the weekly. So I'm holding this one, and that's what I've got presently. But let's take a look at some of the other stuff that's going on here. So the last 10 trades that I've had, 4 wins, 0 break even, 6 losses. That doesn't sound so good. But the way that I look at my wins and losses, I take a look at my wins and losses not just as, what trades are closed. I'll take a look at my open trades, and if my stop is not at break even, I'm treating that as a potential loss, because it would be very easy for price to cycle into the loss column, right? So let's say that on Texas Roadhouse, let's say that on Monday it continues its decline and stops me out. Well, that's a loss. So the way that I'm looking at it as, okay, if I'm going into Monday and thinking that this is a loss versus just something that I'm not going to count yet, then that's something that can help to temper my sizing and help me to be a little bit more conservative. So that's why I like to do it that way. So that way I don't start to get ahead of myself and start to bet heavier when, in fact, this could be a sign that, you know what, it's time to ease off the gas even more. But that's what the 4 wins, 6 losses comes from. But last week, let's take a look at the trades that were closed last week, and then we'll get into how June was really my best month of the year so far. So let's take a look at Meta, TWST, BIRK, PANW, and NU. Right, so here's Meta, and Meta was looking good for the most part. It broke out on Thursday, and then on Friday, for most of Friday, it was looking good. And then all of a sudden, at the end of the day, it had this big drop off, and it hit my backstop. I had a backstop just under the 10 EMA, just under this support area that was developed at 503.90, and I was stopped out of this trade. Instead of taking what could have been, right, or leaving my stop down here and allowing a potential 5% loss, I raised my stop and I took about a 2% loss on this one. Now you might be saying, why would you want to exit a trade early? Why not give it the benefit of the doubt? Another reason for that has to do with me going back, doing post-analysis on my trades, and what I found was that most of the stocks that would also go and be big winners would hold above the 10 EMA, hold below a daily low, and hold below a whole or half number. All three of those things. And so that's what gave me the confidence to start to raise my stop over here, because if price were to fall and do what it did, it's unlikely that this is going to turn out to be one of my big winners. And let's say that it does turn around and be a big winner. Well, I could always get back in. The only thing that I need to do is wait for the stock to set up. That's always the case for all of us, right? Well, we just need to wait for the stocks to set up properly, give us the best opportunity for success, and then trade those. For me, in this instance, Meta was not one of those. But there were a few names that were pretty good. Let's take a look at TWST. TWST, this one was closed out last week. It fell below support over here. I had multiple scale outs in this one already, and let's take a look at the spreadsheet here, because this is something else that this whole thing gets sent out every day. So this isn't just something that I keep to myself. I share this with all the people in our research program. And again, if you're interested in that research program, you could test it out for free for 2 weeks. And if you're someone that's already in our premium or VIP service, you're getting the same thing too. The one of the big differences that we're making is that the premium and the VIP services are only going to be open to people that are in the research program as an upgrade. So that way it's going to act like a prerequisite, right? So that way, if you're coming in and you're coming into the private community, everybody's already speaking the same language. You have the same kinds of questions. You're able to help one another better. And so it's helping to streamline the program. And so that's one of the things that we're doing. So anyhow, closed trades, that's what we were going to look at on here. So closed trades, right? So this is pretty big font over here, right? So TWST made about 13.5% overall on this one, 4 times my risk. Then on this one here, I think that's BIRK. Yeah, BIRK made 14% on this one, about 2.5% times my risk. Here's what BIRK looked like on the chart. Right, and so this is another one too. It broke out down here, solid breakout, solid follow through. I took some off over here and allowed it to run because earnings was the following day, and sometimes earnings could go the complete opposite way. But from what I was observing back on this day here on May 29th, it warranted being held, and so it blasted off, and I sold some more into strength over here. then it formed this rising wedge pattern, and then I exited. And now price is consolidating again, and we'll see what happens there. There were a couple of other ones. Palo Alto. This is one where I took this one early. I ended up getting shaken out earlier in the week, and I did not get back in on this one. So this one is actually still doing well, but it's part of the same cybersecurity group, and so that's good for CyberArk. Here's NU. NU was one that I took on Monday and was shaken out right away. And this is another thing about trade management. So this one I bought right over here, right at 12.32. Price started to move up and move up very quickly. It generated more than 1 times my risk on this one. So what I ended up doing on this trade was I moved my stop to break even right away, right? Like within the first 5-10 minutes of the trade. And the reason why is because I'm already up 1 times my risk. So if I leave my stop down here, I would be essentially risking twice my risk, right? Both my initial risk and everything that I already gained. So that's why I raised my stop up so quickly. And, well, it turned out to be nothing trade because I was taken out at break even, and then price fell the rest of the day, and it would have hit my my full stop if I didn't do that, and price ran back up. So this was one of those very choppy kind of trades. Not easy to trade, but because of how I management, I didn't have that. I'm not sitting at a gain on this one, but I also am not sitting with a loss on it either. Now, let's go back to the slide deck. And June. June is the best month so far, by far. 12% gain on average. So my average winning trades generated about a 12% gain. My average losing trades only generated about a 2% loss. And so that shows the power of cutting the losses early. Because if a stock is a loser, and if it's showing signs that, hey, it's most likely this one isn't going to work out, it's better to cut that loss faster, because it means that the winners have less heavy lifting to do, right? So let's say that instead of a 2% average loss, let's say that it's a 5% average loss. That doesn't seem too bad, right? But 5% is still pretty small. But you cut that by more than half, and this turns into a monster month. Here's the spreadsheet again, and I keep a monthly tracker in here too, and these are the stats, right? So you can see that this was the best month of the year by far, right? You add up all the wins and the losses, and you come up with over 50%. That's kind of insane. You add up all the wins and losses for some of the other months, and it's not quite as good. Well, this was May, right? Not quite as good in May, but if you sold in May and you went away, you missed out on June. So there's that as well. So the main idea with this is that we want to allow our winners to run. We want to cut our losses short. And also, here's another thing. If you're actively tracking your stats, you're going to really know if you should be letting your winners run further or starting to reel them in when you have these smaller gains. Right now, right, as of June, my average high watermark is 28.5%. So that means that on my winning trades, on average, they almost hit 30%. So should I be letting my winners run further, or should I start to reel them in a lot quicker? I should be letting them run, right? So that's helping me with the trade management aspect. Different story back here, back in, what month is that? Back in March and April. Back in March and April, my average high watermark was only 8-9%. So I should be taking gains a little bit quicker then. Sure, the largest ones back then, 25%, 20%. So there were a couple of ones that did fairly decent, but they were further and farther between. Now you take a look at what happened in May and really in June, and now you're starting to see more of them have these larger gains. So that's why I'm letting more trades run further, and I'm less I'm not taking the gains quite as quickly. I'm allowing them a little bit more breathing room because, well, you observe what your stocks are doing, what your performance is, what your system's doing, and it will speak to us if we allow it to. Finally, let's go back to the slide deck and we'll wrap up here. So the road ahead, still red, right? Even though, and this is coming off of my personal best performance month of 2024. Red condition, right? Not what you would think, but when you have all these gains and you take a look at the market, right? It's not where you want to start investing heavily. Like let's say you had the grocery store, right? And you had all this. Let's say that you just got paid this week, and you go to the grocery store and you've got this big wad of cash in your pocket. It's not time to start buying up everything in sight if the shelves aren't full and the stuff that's there, half of it's moldy, right? You want to wait until the good stuff shows up. That's the time to be investing heavily. And when I take a look at this market, there's not that much really in there. And apparently, I can't spell today because I put in soft rare again. But hopefully this at least makes sense. So my tactics to start the week next week are to continue to stay selective, use smaller sizing until the market improves. That means 6.5% capital allocations, 0.5% maximum risk, and that is it. So hopefully you enjoyed this. Hopefully you get a lot out of it. I wish you all the best. Happy 4th of July next week. That's coming up too. And once again, if this is the first time that you are watching this and you're watching this over on YouTube, make sure that you like the video. Make sure that you subscribe to the channel. That'll not only help boost this out to more people, but it'll also make sure that you see the videos when they pop up in your feed. Drop comments. I read all the comments. I do my best to answer the comments over on YouTube as quickly as time allows. And if you are interested in getting the daily research, I put out videos like this every single day. The ones that I put out Monday to Thursday are a bit shorter. The weekend ones are a little bit longer. But you could take a free 2-week trial, and I'll include a link somewhere in the description over on YouTube. And that's it. So take care. Much love, everyone, and God bless.